The US job market just made a huge shift and it's creating massive opportunity. Four key changes are unfolding as we speak. And if you act fast, you could make some serious profit in 2025. Don't miss out. Here's what's going on and what you need to know. So, first in this video, we're going to be talking about the four key changes that are happening as we speak, what these changes actually mean for the greater economy and ultimately for you and your wallet, and then how you can position yourself to profit from these changes specifically in your portfolio. So very briefly, why Fiona? Why should you listen to me? I've helped 453 millionaires build their wealth. I helped manage $600 million. I actually practice what I preach, so I became a millionaire with the same methods I'm showing you today. At 27, I was a student at Harvard, MIT, and I got my CFP certification, 11,000 hours of studying and 7 years in the industry. So let's get started. First of all, let's talk about what the unemployment rate means. It actually just went up. And I got a cool graph here, which is literally the unemployment rate graph, where we can see that it went up to 4.1%. Now, this year's over time, starting in 2022 all the way to 25. And this here is the most recent data. Now, what you can see is it was at 4.0, as we see here, and it went from 4.0 up to 4.1% in unemployment rate. Now, it might not sound like a lot, but it could mean as things and trends are changing and shifting, maybe this could impact the economy worse, adversely, or perhaps not. But we're going to get into those details in a second. As you can see, it did shift from 4 to 4.1%, and I wanted to take a deeper dive into the industry because maybe there's one industry over another that adversely impacted the jobs report. So we can see that there are typically 14 industry sectors. 11 actually went up in terms of unemployment, 3 saw declines, which is what we want, right? We want a lower unemployment rate. So the top industries here were education and health services, which makes sense given recent changes. For example, the education department. Financial activities, which also makes sense just because of the stock market, what has been going on, the recent volatility. And then construction. Things are slowing down in the industry as well. So this does make sense in some aspect. I would expect that government would probably be increasing from 11,000 much higher. Again, this is a couple weeks old data. So as we get further into 2025, we'll probably see government jobs tick up here in terms of unemployment rate. Leisure and hospitality decrease, probably because the leisure and hospitality industry is recovering. The retail side, professional and business services, and so on. Utilities is pretty safe, in my opinion, in terms of recession proof, right? Utilities are necessary regardless how the stock market is doing and generally is insulated from volatility, generally speaking. So what does all of this mean in terms of the unemployment rate? How does this potentially impact you? So first of all, it means that there are fewer jobs being created. Obviously, for an economy to employ everyone, you need to have enough openings, right? So right now, this means that there's not enough openings out there. It also means that consumer confidence is falling. And typically, when consumer confidence goes down, that means that they are expecting the R word or a recession. So this is where we want to kind of pay attention. Why? Because this is like a domino effect, right? What that means is if you expect the economy to do poorly in the next year or so, you're probably not going to go out and spend $10,000 on a vacation because you want to have $10,000 in case you're let go. Because you spend less on travel, for example, or on whatever else it would be that you would normally spend the $10,000 on, or even $1,000 or $100, then that money isn't flowing into the economy, which then causes it to stagnate, which causes companies to stagnate, which might cause people to lose more jobs, and it's ultimately a downhill battle. The more people that lose confidence in the economy, the more likely it could be that this is actually a domino effect impacting the greater economy. Again, this is more on a larger scale, right? So this is typically a large scale item. It means more, like a lot of people need to have low confidence, which could ultimately cause the economy to topple or go downhill. Now, there is something that you should know. If you know where to look, right? If you know where to actually look, you could make serious gains in the next couple of months. And that's what I'm going to show you here next. So, what are some of the key changes? The job market is steady and possibly slowing down. And again, this doesn't surprise us given the job market, the unemployment rate trends. The unemployment rate just ticked up slightly, which means the job market is slowing down. It's staying steady and likely decreasing. We can see this trend, right? It is going down. We can see that the jobs added per month has been slowing down. Again, it's no surprise, but over the long term, we know the trend is downward. What does this mean? Could it lead to a recession? It potentially could, right? We don't know this for sure, but the indicator, the downward trend that we're seeing here over the last couple of years, right? Since 2021, we know in general, 2021 was a pretty strong year in terms of the job market, right? Like the economy was bouncing back, supply chains were bouncing back. So companies needed to hire people because of the huge backlog from supply chains. Like they needed to fulfill orders and requests from COVID, right? But then as these orders and requests were starting to get fulfilled and were actually fulfilled, that's when the job market like really started slowing down. Starting in about 2022, 2023, right? And that's where it became a little bit more steady and still continued the downward trend. Jobs report offers few surprises in February. Again, this is not rocket science. It's not a huge uptick. We're looking at, 10 basis points in increase, so 0.1 percentage point increase, which is not much compared to before. But again, the fact that overall the trend has been upward in terms of unemployment is a little bit worrisome. Again, not a huge red flashing indicator, but still a little bit concerning. Something to keep an eye out. So how does this impact you, and what does this necessarily mean? So again, it means the economy is cooling. It does not mean we're ready to go and jump into a recession tomorrow, but it means you should keep your eyes open. It also means companies are scaling back, right? So there's hiring freezes, whether it's on the university level, whether it's on, so university being higher education based on policies that are being implemented by the federal government due to the administration change, or whether scaling back means regular technology companies, which also have announced hiring freezes due to the advancements of AI, essentially supplementing or potentially replacing, I'm not sure if replacing is the right word here, but they're certainly supplementing workers in coding, for example, or other tasks that might be done faster, more efficiently, and at a lower cost with AI. So that is one of the reasons also why maybe the job uptick has been increasing / remaining steady. Businesses are also cutting back on research and development expenses and hiring. So as businesses are cutting back because they're noticing that the economy is cooling down, what does that mean? Less investment in R&D, research and development, means that there's less innovation, right? I mean, Apple, for example, they just announced, I think, like a new phone or something like that, or new headphones. But when was the last time you actually saw a legit innovation like the iPhone, for example? It's been a while. Of course, Apple is not the only company. It's the first one that popped to my mind. But the point stands. If you don't invest in R&D, wherever you are, whether you're in utilities, whether you're in technology or something else, that means your innovation is going to slow down, which means your products to market are not going to be as potentially cutting edge, which might lead to lack of product purchases, which means potential lack in revenue. This can be evidenced in recent earnings reports where large corporations have announced a slowdown in their overall earnings, likely driven by, again, this cooling economy, a decrease in innovation, which ultimately leads to a decrease in growth. Return to office mandates are also increasing. We've heard of JP Morgan Chase, Jamie Dimon, right? Oftentimes having these return to office requirements for workers to either get paid their full regular salary or to even be employed. Employees or workers aren't thrilled about that. I know some employees, they want to keep their, 2 days a week at home remote and then 3 days a week in the office. It seems like that, at least for larger corporations, is no longer an option. Companies want this because they believe this increases productivity. Of course, workers might have different thoughts, so this could lead to potential churn, maybe not. However, in general, it does seem like returning to office does lead to an increase in productivity. At least that is the goal for the companies. So why does all of this matter? Why are we looking at these numbers and these graphs? Slower job growth essentially means less consumer spending. We kind of talked through that, right? Which also means weaker corporate earnings, meaning if you don't spend, normally if you spend money, right, it goes into the economy, which goes into the company, right? And then if the company is flush with cash, that company can invest in their employees, they can hire more people, they can invest in innovation, they can increase their product, they can improve efficiency, right? All of that. However, if you spend less, your money isn't going into the economy, which ultimately means the money's not going to the actual companies, right? Which means weaker corporate earnings, meaning investors like you and me aren't getting dividends. Because if there's less earnings, if there's less revenue, less money going out into the economy from you and me, the consumer, then the investor, you and me, are also not getting money. Again, the company shares a piece of their profits in the form of dividends, for dividend stocks at least. If they're not getting any profit, they're probably not going to be able to spend as much on the investor, or I should say, that stock price decreases for the company. Again, if that company's not getting the cash from the consumer because we have less motivation in the economy, less confidence in the economy, the stock price can also go down. If the company reports in Q1 earnings, which is essentially or should be coming out in the next couple of weeks now for 2025, that could cause lower stock prices. So moving on, investment insights. How will this impact your money, and how can you position yourself ahead of the curve? A weaker potential stock market, and we have seen quite a bit of volatility, right? Could mean slower market growth. Again, this is not rocket science. This makes sense. Which ultimately, slower market growth ultimately means potential opportunities in the defensive sector. Again, utilities and healthcare as well. Why? As I mentioned earlier, utilities specifically, and also healthcare, and typically defensive sector, especially with the new administration, there might be some spending here in the defensive sector, right? So this sector could be increasing. Why? Because it's getting pumped with money from the government, for instance, or from individual consumers. Utility and healthcare, these are sectors that will be needed, that will be in need and in demand, regardless of what's going on in the economy. People are going to get sick no matter what's going on in their finances, and people will need utilities no matter what's going on in their finances. Utilities being electricity, being power, light, water, things like that. So these are 2 or 3 sectors that are generally recession proof. Again, I don't want to say these are the end all be all, but these are some good sectors to at least think about and position yourself ahead in advance if you want to avoid volatility and the potential decrease in your portfolio value. Moving on, another key change. Consumer confidence is falling. We already spoke about that. What does it actually mean? It means they feel less secure about their income. Maybe they're worried about losing their job. If they feel less secure, that means they spend less, right? Because again, would you spend $10,000 or $1,000 on a nice trip? If you're insecure of your work, probably not. At least I wouldn't, because I would want to have enough money to pay my bill for rent, for food, like basic food, for my utilities, right? That's where utilities comes into play. Utility takes priority over vacation. So if I don't spend that much, businesses are not going to do that well, which means stock prices don't rise. And here's an example, actually, of the Consumer Confidence Index, the CCI, which is a regular measure that economists use and investors use. I used it as a wealth advisor when I was working in wealth management to help predict, or at least help understand, the direction of the economy. This is something where it essentially helps us. By predict, I mean it could be considered a leading indicator, right? Because as the consumer confidence sharply decreases, it decreased before the recession of 2008, the great financial crisis, right? We already saw a pretty sharp decrease in consumer confidence. Now, for 2020, COVID was pretty different compared to other recessions. But again, it did decrease like during the recession. So oftentimes you'll see, or you should see, a sharp decrease in consumer confidence just before this gray bar, which means a recession. For COVID, the recession was so short that there probably wasn't enough space for you to see like this consumer confidence drop. But there certainly was a drop. And now once again, we're seeing a sharp decrease. Now, we saw a sharp decrease in this moment and these moments. Does this singular chart necessarily mean there's going to be a recession? No, it does not. However, this chart paired with 5, 6, 7 additional charts out there, each of them showing a downward trend, then potentially we might be much closer to a recession than we maybe thought initially that we were. So again, don't just look at this individual chart to figure out whether or not we're going toward a recession, but it does give you an idea of where the consumer lies with their confidence and what could potentially happen. So why does all of this matter? It matters because a decrease in confidence also means a decrease in retail and tech stocks, which is exactly what we've been experiencing. Specifically, Apple has been underperforming, Target has been underperforming, and if you take a look at the top, I believe, 7 companies of the S&P 500, which should be generally the tech stocks, right? So Apple, Google, etc. These, if I am not mistaken, are actually in a bear market, right? So they are not actually performing that well. Just those companies in and of themselves. So if you take a look at them and you exclude all the other companies that make up the S&P 500 and just look at the top 5 tech companies or top 7, you'll see that there is a trend there. Does it mean that the rest of the companies in the S&P 500 will follow suit? Probably not, but maybe. So at least something to pay attention to. So what does this mean for your overall investments? It means if the consumer confidence keeps decreasing, then you might want to position yourself in these 2 sectors. Not a surprise, utilities and consumer staples. So consumer staples just means consumer basic needs, right? Whether that's like food, basic grocery stores, like in other words, I would be looking up companies that are suppliers like potentially even Walmart, for instance, or big consumer companies that produce like agricultural products, so large agricultural producers, because again, we will need to eat one way or another, regardless if we're in a recession. Who produces the food? Who produces clothes, right? We'll need clothes, maybe not as expensive, but we'll need clothes. Those types of companies, those sectors, I would be looking at. We will need, basic necessities to continue to survive. Those are the sectors I would be positioning myself into to preserve capital, right? So my principal, my money doesn't go down and lose value, and I continue to make somewhat of a profit even in a recession. All right, key change number 3. The Federal Reserve is holding steady on interest rates. So the Federal Reserve, essentially in America at least, it predicts, or it sets, not predicts, it sets the interest rates. And the interest rates have, depending on the type of interest rate that is set, it has a whole procession of domino effects and chain events that are related to it. Whether people invest in the stock market, whether people don't invest in the stock market, interest rates predict how many people, or help predict how many people will get a house, go out into the market and actually get a mortgage, buy a business, take on debt. Now, oftentimes the thought is, if interest rates are low, then that would start to start to churn the economy. In other words, start moving the economy because debt is cheap. So if an interest rate is like 3% or 2%, right, like it was for mortgages, right? So mortgages, think back to 2020, think back to 2021 when mortgage rates were like, 3% for a 30-year mortgage. People went out and bought houses. Why? Because it was cheap to have a 3% interest rate. And then the Fed bumped up the interest rates, which we'll see here in a second. Actually, I'll show you here. So you'll see in 2020, right? During this time period, during COVID, the economy wasn't doing that well, which I'm sure we all remember. People were laid off, everything was stagnant because of the mandate to stay at home, right? And that caused the economy to slow down. So the Fed, one way at least to help the economy get back going, get back rolling, was to lower the interest rates, which would help people, borrow money at very cheap rates. So that means people could start businesses for really cheap. People could go to school for really cheap. Like student loans wouldn't cost that much money. Instead now, as you can see, after they kind of got the economy going again, they bumped up interest rates really fast. Of course, also for other reasons, to fight inflation, for example, being a big one. And that's where interest rates went back to a pretty high period, right? Over 5%, 6%. And we saw that kind of work its way into the mortgage situation, right? People started slowing their home purchases because in part due to these interest rates. So now the Fed has lowered the interest rates again to help try to get the economy going again, try to encourage people to go back out to get debt, right? And then ultimately buy businesses, etc. But that has at least recently stagnated a little bit. It's just a small blip. Who knows how it's going to turn out? But in the short term, we do see that there has not been that much change in the interest rate market. And that's where I'm getting at. Now, because the current status, because rates matter, Jerome Powell, who is the Fed chair, so he is one of the key decision makers, or the key decision maker. Essentially, he's saying that the economy is stable, right? And it has been stabilizing. So the Fed is pretty hesitant to cut rates too soon. They don't want to set off a chain reaction either. So it's all about timing, really. So because they've been hesitant, there might be some stagnation. Typically, lower rates means more borrowing, which means more business investment, which means more market growth, right? That's what I've been explaining the last couple of seconds, and here's just a quick example. This is the chain reaction of events, why lower rates in general can be helpful. The current status, the Fed is signaling caution. That's why it's been so steady with its rates. There's no immediate rate cut expected. It could change, but right now that is not the expectation. So you can also see, this is just showing how much money the Federal Reserve is holding. We are looking at an all-time low, right? At least compared to the last 3 years. And that the reason why is because it tried to boost economic activity. So the Fed used its money and tried to buy, certain assets, certain financial assets. By buying financial assets, it moved money into the economy, which lowered its overall balance, right? Its overall balance of assets. So now the Fed really doesn't have that much in assets. So it can't really stimulate the economy anymore because it doesn't have that much in assets, less than $7 trillion, right? And it will continue to reduce its bond holdings. So overall, why does this matter? Why is this important for you to know? Again, lower rates could mean a rally in growth stocks and financial stocks. However, right now we're not at that point. So higher rates, we are still in that higher rate territory. It means that there's pressure on debt and debt-heavy companies that have a lot of debt. So these are big companies that do have debt they need to repay. How do they do that? Maybe it depends on how they do this. Do they charge more for their product? Do they try to lower their dividends so the investor, you and me, don't get paid as much from the product, from the profit, and instead they reroute the dividends to pay off the debt? How are they going to structure this? This could leave some investors in the dry. And here's why it matters in terms of investments. First, if the Fed does start cutting rates, let's say they do end up cutting rates in the next couple of months, you want to look at the financial sector generally, like JP Morgan Chase, Bank of America, right? These are two examples of financials who will generally benefit. If rates stay high, defensive stocks could be a pretty good sector. We also spoke about this before. Also, with the current administration, there might be more investment and focus geared toward these defensive stocks. And then finally, the very last key change, number 4, tariffs, right? This year is certainly a point of contention. It's been a point of discussion ever since even before the election came into play. Tariffs have been on the radar. Tariffs on Mexico, on Canada, and on other countries as well, including those in the European Union, could mean money market uncertainty, right? So Trump may have paused tariffs, right? Mexican, Canadian goods, that pause might be temporary. So if tariffs are reinstated, that could increase the cost for business and also increase the cost for the consumer. By cost for business could be the business here in the domestic market, aka in America. If tariffs are not reinstated or if they are back down, then the business will not have higher costs, and that means also the same price to you, right? So take an example here with Walmart and Nike. They could face shrinking profit margins. What should you look for based on that? Domestic manufacturers in general, if there are tariffs, they are designed to protect those companies that are domestic. In other words, companies that are in the United States. They're designed to, it's kind of like a globalization effort or deglobalization effort where the tariffs are supposed to protect any company or worker in the United States, right? Which means companies in the United States, domestic manufacturers, could be seeing a profit. Like Caterpillar, like Deere, these guys could be benefiting if tariffs are in place. So very quick chain reaction to actually illustrate it for you. If there are more tariffs, that means potential higher inflation, which means pressure on growth stocks, which ultimately means trade uncertainty and market volatility, which is something we've already been experiencing. And we also had experience back in 2016 to 2020, right, during the first term of the Trump presidency. So what does this mean on your investment portfolio? If tariffs return, again, like I said, focus on domestic manufacturers. Companies with domestic supply chains could also see higher profits, right? So if the supply chain of the company, so in other words, if the product is being manufactured in America, then and there are tariffs in place, then because the supply chain is also in America, it's protecting, or at least in theory, it's protecting the company from like outside forces. In theory, that could also have higher stock potentially, right? So that's at least the theory behind tariffs. Okay, so what does this mean for your portfolio? Tariffs returning could mean that domestic manufacturers gain. So we talked about Caterpillar and Deere. Rate cuts could mean that financials benefit, right? So we talked about JP Morgan and Chase. We talked about Goldman Sachs or Bank of America being in the financial sector if, again, rates are cut. Falling consumer confidence means that retail and tech stocks could be under pressure, and it certainly is true for the tech stocks. So what does that mean? It means you might want to position yourself, or at least think about it in the defensive play, looking at consumer staples and utilities, which are generally a little bit less volatile during recessionary periods. So how can you position yourself if you are considering yourself a long-term investor? Broad market ETFs, S&P 500, and of course focus on long-term growth. Again, whatever happens in the short term, so far at least history has shown that the stock market always rebounds after a recession. So focus on the long term. If you're an active investor, buying opportunities in undervalued financials, this would require a little bit more technical analysis from your side, fundamental analysis on your side, and then look again at domestic manufacturers if the tariffs go into play, and then volatility could mean opportunity, or does typically mean opportunity, meaning buy the dip. You can of course combine these two mindsets as well. You can buy the dip and continue to focus on long-term growth. That depends on how you best operate. So again, a shifting economy signals opportunity. That's how I would at least frame it. Wall Street is preparing for this. The question is, are you? So hopefully you can start building wealth now using some of these tips And again, if you found this video helpful, please like and share to help others. Make sure you subscribe to my YouTube channel. It's the_MMW for more really cool insights. And then of course, join my newsletter for more exclusive tips. The link is in the description. Your bank accounts will thank you later. Hopefully you found this useful. And again, make sure you always do your own research on top of this. Thanks so much. Take care.